so we love questions from the audience. So you can start commenting your questions now, or you can also add them as we go. I'll be right back on to welcome our guests to the show. Thanks for meeting us for coffee. Good morning, everyone. I'm surprised that went so well because I'm producing myself today, which means my producer Aaron has abandoned me and left me high and dry today for the first time in like 2 years. And I have to run my own podcast intros and outros. But we've survived the first part. So bear with me. If there are technical difficulties today, it is in fact my own fault and lack of preparation to run my own show. But maybe we won't have any issues. So my producer is working the polls in Tennessee. So also happy election day to everyone. I do want to encourage everyone to make time to vote today. I do really consider it a privilege that we live in a country where we are allowed to vote. And so I actually early voted last week because I have a busy day today, but hopefully everyone, if you haven't already had the chance, find some time today to get out and vote. And today we have two guests who are going to be coming on the show. I'm excited about this conversation. I do want to get a couple of announcements out there first. Number one, in the comments on the LinkedIn Live event, you will find the link to register for Manifest, the Future of Logistics in Las Vegas, which is February 10th to the 12th. The Meet Me for Coffee podcast will be there. And I'm very excited about that. We are going to have lots of awesome guests come on. We're going to be creating some cool content. If you guys are interested in having your company come on the show while in Las Vegas, please just reach out to me on LinkedIn and send me a message, and I will get you over the information packet we have already created for that with sponsorship details. There is also a code to save some money on the link in the comments. So if you guys are going to go, you want to go, make sure you go ahead and check out that link. I think you save a couple $100 on your registration. There is also another comment linking more information about TIE. TIE TMS is our sponsor for this podcast. They've been an amazing partner to work with. And we have more information about how you could schedule a demo. You could save $500 there on any future partnerships. And then also they have a free resource out. That's a new one. They have an LTL ebook, which is just kind of some more information about how to explore offering LTL services as a brokerage and how that functions within the TIE TMS. Okay. Without any further ado, I'm going to go ahead and bring to the stage our two guests today, Mr. Graham Gonzales and Matthew Leffler. Good morning, gentlemen. How are we doing?
Good morning. Great to be here. Thank you. You're right. It's election day, everybody. You have amazing power. You fought for this for years. It is available to you. Exercise your right. This is your democracy. Time to act like it.
Yeah, I love that. That was way more convincing than my message. That got me excited. Okay, so gentlemen, I want to kind of set the stage with my thoughts for putting this together real quickly, and then I'm going to ask you to kind of introduce yourselves and talk a little bit more about why you're here. I just saw a post this morning. Mr. Ken Adamo from DAT shared it on his LinkedIn, and it's something I've seen before. So I've always known of this, but it was fun to watch a little GIF, I guess, like portray broker margins over the last 4 years. And really, no matter what year it was, no matter if it swung to the right for higher margin skews or to the left for lower margin skews, there was really always kind of a core average of somewhere between like 10 to 15% as the average broker margins. And I left a comment that is how I have always felt. And it was like, what a wild industry we live in, where as a broker, you have to pay all of the bills and turn a profit and grow on 10 to 15% margins. And I just think it's such a wild industry, but also such an incredibly fun one to be a part of. But that kind of, I have a reason for bringing that up, because as I'm thinking about this, I'm thinking about all the things that are changing in the landscape of trucking, of brokerage, and just transportation in general in the last year, but last 5 years especially. And so a lot of what I think has changed in that space, and I've mentioned this recently, is risk and fraud and theft and legal astronomical lawsuits that are, emerging now. And so all of this is changing the landscape of how these brokers have to operate, probably increasing their cost to operate on those 10 to 15% margins, and just having other implications too. And also, I think we have some shippers who listen to this pretty regularly and some people who tune in. And I want to also address this from the standpoint of partnerships and who carries risk and how do we carry risk and whose fault is it and whose job is it to do things. And so I just want to dive into all that, but I'm going to go ahead and pass it over to Graham to introduce yourself and tell us a little bit more about what you do. And then we'll have Matthew introduce himself.
Thanks, Samantha. My name is Graham Gonzales. I'm the EVP of Sales at Reliance Partners, but that really just means I'm an insurance agent. I like to partner with freight brokers, shippers, warehousing operations, basically logistics companies of all sizes. But people may be a little more familiar with Reliance on the trucking side as well. I believe we're currently the largest insurer of the 1 to 50 power unit fleet. So we have a lot of love for a small fleet. We write some mega fleets as well. So really trucking operations of any kind have been great partners for us. And again, my team really likes to focus on partnerships and risk and insurance solutions for freight brokers of all sizes. So whether it's an ambitious new venture that's just getting set up, maybe a spinoff of a really large brokerage, perhaps it is a large brokerage itself who is looking to change things up. So we're a brokerage for freight brokers in terms of insurance and risk management.
Love it.
Matthew.
My name is Matthew Leffler. I am the armchair attorney. I've been practicing law since 2010. I went to Michigan State University College of Law, graduated magna cum laude. I represent motor carriers. I represent brokerages. I represent manufacturers. You all call them shippers. And the thing about transportation, I want to jump off your initial point here, Samantha. We know the cost of operating a trucking company. It is your fuel. It is your labor. It is your assets. It is your maintenance. And then number 5 and number 6 are either insurance or tires. Those are the things you spend your money on. And as a motor carrier, you've always had razor thin margins. Operating ratios of like 90% is like, oh, we're having a good year. Not everyone can be Old Dominion. And so I think your point, and especially Ken's post earlier about broker margins, look at C.H. Robinson. They're publicly traded. You can see how much money they make. There's not all that much juice there to squeeze. And I think when shippers and manufacturers of all sorts kind of understand the actual cost to move things, it becomes a much more productive conversation.
Awesome. Well, maybe we can shed some light today. So I kind of want to just give you both an opportunity real quick to stage set for us as we're having this conversation today on Election Day, November 5th, 2024. Where are we at right now? What's changed in our recent landscapes? Let's just say over the past few years as it pertains to both of your areas of specialty. So we'll go in same order there. Start it off, Matthew. You got this one.
Oh, wow.
The folks like Graham, the folks helping motor carriers find good insurance and find and brokers finding great insurance, they are staying up very late at night. Now, not only because there's lots of little children all around, but the reality is there are so many new verdicts on the horizon that are absolutely catastrophic to this industry, whether it's the Werner case in Texas, the Wabash case in Missouri, or the new Daimler case. These things are keeping adjusters up at night. And it's important that people understand what these implications are if these verdicts are upheld. This rise of catastrophic nuclear verdicts, as they're called, is not slowing down. It is only accelerating.
That's true. And as they continue to happen one after another, and we don't hear about them oftentimes in the news until years after, it doesn't become a full-blown colossal lawsuit until years after they occur. But what happens is many of these large companies and large verdicts get not just a main insurance company involved, but they get the insurance company of the shipper involved, of the broker, of the motor carrier, of the manufacturer. Every piece of the supply chain gets pulled into these. And so insurers across the board are actually all seeing a piece of this action. And what that means essentially for the industry is that as these colossal cases continue to happen, we're actually going to see an impact industry-wide. It's already begun on the theft side. We're seeing an immediate impact on insurance premiums, rates, even the way coverage forms are written. But Matthew, to your point, with these really auto liability nuclear verdicts, what we're seeing is there will be a reckoning in terms of excess liability and auto liability markets, because these insurers are businesses. They've got a P&L to maintain and manage as well. And so they need to keep themselves above water. And so seeing down the pipeline that something colossal is coming is keeping these insurers up at night. It's keeping us up at night as well. And it's definitely keeping our broker clients and our motor carrier clients up. So as these things can continue to happen, not only that, as they gain popularity in the media, what we're going to see is larger and larger verdicts, I think. Sometimes even for smaller cases, right? Less injury, bigger amounts.
There's a thread I want to pull there, Graham, because one of the things we talk about in this industry, so the minimum insurance required to be an interstate motor carrier established in 1980 was $750,000, $750,000. And what we're finding is motor carriers are using that policy, and that's what's getting the brokers involved. So a broker who has probably more insurance, are you seeing your clients talking more to you about like, hey, what happens if this motor carrier that I have is underinsured? Do you think about that? Does that keep your brokerage customers awake at night?
It needs to be a consideration, because think about this, Matt, if you hit me in my personal vehicle and I'm in my car and I get out and say my back hurts, I can exhaust your 750. You know, it's not out of, it's not out of the question by any means. So it can happen quickly, not even for a fatality type claim, just for, my ankles hurt, but it's going to change the rest of my life. It's going to change. I can't do my job. It changes the course of my history. So these lawsuits, go ahead, Samantha.
No, I was just going to say, like, let's do this real quick. I think like Matt just brought up an excellent point. Graham, you're getting on to answering it. Well, real quick, a couple of things. Matt made a comment about lots of children keeping you up at night. And I just want everyone to congratulate Graham because he has a new baby at home. I think 2 days old. So very grateful he's coming off paternity leave here to pop in and say, share some insights with us. Also, good morning to everyone. We have Chicago represented, Kansas City. Hey, go Chiefs. That was a tough one last night. And then Charlotte, North Carolina on as well. So thanks guys for being here. Let's kind of stage set with what is, I don't even want to talk about like what's required. Maybe you mentioned what's required, but right now across all of these companies you guys are servicing, Graham, and when you guys are getting people bringing in policies and asking for new policies and looking at policies, what are we looking at right now for kind of, let's say like this is what is more or less considered the base minimum to be taken seriously, to be able to execute contracts right now and to operate as far as broker insurance or maybe even motor carrier insurance. And then also I would like to talk about if there's been any changes in what base minimum expectations are from shippers when they require a contract be signed stating you have certain types of insurance agreements in place. We don't need to get too into this. I just want everyone listening to kind of know like where is the like ground zero right now for insurance.
Yeah, there's some good things to chew on here. So first of all, as a motor carrier, considering the minimum 750, if you purchase that, fantastic. You've accomplished what you need to run the business from an insurance perspective. However, think about from a broker perspective. Are they going to tender loads to motor carriers who might be equivalent on paper, but one of them has a higher limit of insurance, there might be a little bit more faith that that motor carrier might actually win more loads and be able to operate their business in a more profitable fashion, just because they've increased their insurance limit to what I would consider a really great minimum with $1 million in auto liability.
I would just like real quickly add, when I was a broker, we looked with like highway and other features. When you're carrier sourcing, you can filter by insurance, and like we just started at $1 million. So like the 750, we were kind of like, if we had to, we would go through additional vetting measures, just because to us that told you like you're taking your role here as a carrier a little less seriously than others. Right, wrong, or indifferent. That's how we operated. And
there's many brokers that put in their vetting software, they're going to put in that exact parameter, and it's not even in consideration. So there's people missing out on business because they're not purchasing this higher limit of insurance. And it's not that much higher from a lawsuit perspective.
That's right.
That gap is really, it goes so quick, and it can go straight to lawyers as opposed to going to the actual, like anything that you're actually due to pay. So that's a consideration from a broker to a shipper perspective as well. There's another consideration, which is that shippers have a lot of expectations of their broker partners, of course, because they're entering into a service agreement with each other. And so what we're seeing is a broker purchasing $1 million in auto liability. I don't think that brokers and motor carriers have the same minimum, if you will, in terms of what is becoming more normal in terms of the limits of insurance they're purchasing. So for auto liability, general liability, we're seeing $2 to $3 million is a lot more common, based on brokers simply wanting to protect themselves with that limit of insurance, in addition to shippers requiring it of their broker partners. And more normal this year than any year I've seen is a $5 million limit of auto liability and general liability. That's a high limit, but what are shippers accomplishing by requesting of that? They're trying to protect themselves. They're trying to protect their broker partners potentially. And they're also basically excluding other maybe businesses, Samantha, like you pointed out, in the motor carrier end, that aren't investing in their risk the same way. So a broker who has $1 million in auto liability versus a freight broker who purchases $5 million in auto liability. If you have two certificates of insurance in front of you and everything's equivalent but that limit, which broker would you prefer to partner with? I think it's a pretty easy question. And so this is becoming more normalized in the industry as shippers have expectations of their brokers, as brokers have expectations of their motor carriers. It's all getting passed down the hill here.
So from what I've experienced, I'm going to ask this question to Matt. Typically, the larger the manufacturer, the shipper, the larger the company they are, or the more public they are, the higher the terms for insurance coverage. So is that like, is there a direct correlation there between like the bigger you are, the bigger the head on your, the target on your head is from any potential like lawsuit filings, Matthew? Is there like, or is it just like we are just, they have a bigger legal team, and since the legal team's bigger, they spend more time thinking about how much we want to ask out of people on contracts? Like, what is the thought process that goes into that?
I think as a practical, tactical way of understanding this, when capacity is loose, you can make whatever parameters you want because you have so many people who are competing for your business. Big manufacturers clearly understand the liability risk that is out there for anybody who's moving freight. That's why they use the intermediaries that they do. The rise of the freight brokers over the last 20 years, moving 6% of freight now to 20 some odd percent of freight, is an exercise in how do I remove myself from the liability calculation. So the broker takes on the liability, the broker then outsources the liability to the motor carrier, and the shipper, the manufacturer, is sitting back and saying, I'm feeling comfortable with this. When capacity changes, maybe those parameters differ because then you need to move things. The couple things that worth kind of noting on the insurance side. So we tried earlier this year, not we, but the country did, to have a new regulation on the minimum insurance required to operate a truck interstate. And that was an act called the Fair Compensation for Truck Crash Victims Act. And that would have an interesting name. They were trying to raise the rate to somewhere above $2 million. Now, if you were to adjust it for inflation, that $750 we talked about earlier, it would be over $4 million today. So we are not as insured as we need to be. Big manufacturers have not been tagged with these big lawsuits. If they operate private fleets, they're clearly aware of what's happening. They clearly know the trends and forces that are shaping what they do. The other thing I'll note, and I think this is something that I'd love to get Graham's thought on, 21.6% of all commercial vehicles on average are out of service. Like if you inspect 1 in 5 trucks on the road, they are not safe at any speed. And that is,
I think the
Yeah.
Road Check Week was like 26% or something, wasn't it?
23
were
during road
unfit.
check, 23% of commercial vehicles inspected failed. 23%, and
That
that's
is
not an aberration.
horrifying. So like, I mean, 23%. Like, I bet at 23%, you could pick almost every like Fortune 500 shipper out there and say one of those trucks was carrying a load for one of them.
Oh, absolutely. I mean,
Oh, yeah.
and the defects are brakes, lights, and tires. BLTs, delicious for a sandwich, terrifying if you're a motorist. So, like, our industry wrings its hands. They say, oh, there's a driver shortage. That's not true. Oh, the plaintiff attorneys are too aggressive. That's probably maybe partially true, but really, it's us. We're addicted to cheap and fast stuff, and cheap and fast stuff requires not to maintain our equipment or carry adequate insurance. Then you have a case like Werner down in Texas that is catastrophic for this industry, and we'll know more about that on December 3rd. So there's a lot of stuff happening.
So help me
I'm just going to say,
understand.
I go to Matthew Leffler for my Werner news recently.
How effective is insurance if your brakes, lights, or tires were not maintained properly?
This is the way that we do this. I'm going to kind of talk about the story of how a plaintiff attorney destroys a motor carrier or destroys a broker if they're able to do that. What I look for is I say, look, it's not about the driver having a bad day. That's not it. It's really about the pattern and practice of the motor carrier. And if you say, I believe in safety, and I say, well, let's look at your vehicle maintenance records. And I say, well, isn't that interesting that your out of service rate is the national average, 21.6%? That might be good enough for the FMCSA. It's not good enough for most Americans to understand how dangerous you are. And so liability is about following processes and seeing how you deviate from them. Let me set the stage, because I think Graham teed up the Werner case quite well. And I think everyone who's watching, the shippers, brokers, motor carriers, this case is the most important case in our industry right now. The story is terrifying.
I agree.
A driver operating a commercial vehicle in the snow in Texas is going under the posted speed limit. This driver is brand new. He's been driving for Werner for about 7 days. His trainer is asleep in the back. For those who don't understand this, in our industry, drivers with a trainer are treated like teams. So one is sleeping, one is driving. That trainer is not monitoring what that driver does. Our operating margins do not support 3 people in that truck. That is how it runs for every single motor carrier, for the most part. In the opposite lane of traffic, in a different direction, is a pickup truck. And they lose control because they're driving too fast for conditions. They lose control, they spin out, they cross a 10-yard median. And in seconds, they collide head on with the truck operated by Werner Enterprises. 1 child dies and 1 child is catastrophically injured. And the question is, who's at fault? Who's responsible for this? It goes to trial. At trial, the driver for the pickup was found to be 16% responsible. The driver for Werner was found to be 14% responsible. Now, I'm not Ken Adamo. I'm not a math guy. It's not my thing. But 14 and 16 gets you 30%. 70% liability was found to be for Werner Enterprises, a verdict of over $100 million. They appealed it, and on appeal, they lost. And on December 3rd, 2024, is the oral arguments, the big argument between the counsels and the judges for the Supreme Court of Texas to say, is this right? Is this the correct outcome? If you're a motor carrier, how in the world do you anticipate the actions of another person? How do you do that? As an insurance company, how do you associate that risk? You can't. And so we are watching on something unfold that is catastrophic. But brokers, you're not immune. We could talk later on about the Miller case and the Global Trans case, but those 2 cases show that maybe a broker could be held to the exact same liability as the motor carrier. That case is bananas. So I talk about this as often as I can because a lot of people need to understand this is the future. It's not going to stop. It's bananas.
You really know how to bring it down, Matthew.
Man, this is the story of our supply chain.
But this is where I come back to it seems, unfortunately, in some cases, and hopefully they are very, very few in comparison to what actually happens out there, that it does not matter what insurance, like Werner doesn't have bad insurance. We know this. Werner has very structured maintenance programs. We know this. Like they're just, we would assume, right? That with the size that they are, they have regulations on shops on site. They have their own technicians at all these shops. So if someone like that, who's checking the boxes on training, on maintenance, on insurance, can still be caught up in these types of lawsuits, I think that's what is very concerning. to people who are a fraction of the size, right? So I would again say this comes back to, yes, consider what you can consider with insurance. And to me, the simplest way to help protect yourself is to actually have some type of record of scheduled and regular maintenance and keeping up with all of your maintenance requirements. And that just seems common sense. But like we already talked about, we have 21% of trucks on average that don't have that.
I talked to an FMCSA regulator at an IANA business meeting. I asked him, like, what do you think? As the FMCSA, what do you think about 21% of vehicles being unsafe? And he's like, well, we believe that fatalities are derived through the hours of service abuses. Oh, Brandon's quote is exactly right. So yeah, Brandon, this is exactly right.
I was like, I don't know anything about this, so I'd love to know.
Yeah, so a big motor carrier, they say, look, we don't need to go to someone like Graham right off the bat. We're going to have $10 million in a pile of money that's self-insured for these accidents. And if our self-insured like bunch of money gets exhausted, then we have an umbrella policy that comes in and helps us. So the mega motor carriers, one of the reasons why they're so cost effective is that they do not insure themselves for these things under 10. If it's above 10, then they will tap into insurance. So they're operating at a level that is probably very much more competitive than a small owner operator. That is exactly what the big motor carriers do.
And Matt, I'm going to tie this to how it affects the rest of us as well. So on a company like that, who might self-insure the first 10, 15 million, and then they utilize probably several insurers. They're going to sit in towers. Maybe each of them insure 5 million up to the next 50, 60, 70 million if it's an enterprise fleet. Well, what happens when they do exhaust their limits, which some of these cases are looking like they're going to exhaust their underlying limits. And if they're found liable, it will exhaust their full underlying self-insured retention. And then these insurers are going to get hit. Well, the insurers see that coming down the pipeline. And because it is unlikely that a lawsuit over 10 million is going to occur, they're oftentimes going to price this excess liability, this tower, at an affordable price, essentially. But if something does happen, and they can do that for years and not see a claim on it, but when one mega claim does happen, it's going to hit industry wide, because let's say there's 7 different insurers, many of them Lloyd's of London syndicates that specialize in broker insurance and excess liability. When they all get hit for $5 million, it's going to sink their books of business for that year and for the coming years for a lot of them based on margin. So what's going to happen is, to stay above water, everyone, the safest freight broker who's never had a claim, the motor carrier who's never reported a claim to their insurance and is operating in service, they're all going to see increases in the rate of their insurers, because these insurers took a bet on these high excess liability towers because it seems like a good bet. It's a good risk to insure. It's unlikely something's going to happen. But when it does happen, it only hits big because it's oftentimes over that $10 million limit. So that's what I said earlier. There's going to be a bit of a reckoning coming in the insurance section of the transportation industry, because these insurers are going to need to stay above water. We might see some fold potentially. If there were some smaller syndicates that were involved, they could potentially, but I don't think we're going to see insurance companies close their doors necessarily due to these nuclear verdicts, but it will have a repercussion.
And what I like to build off what Graham just said here is that there's a really important distinction that everyone I've ever talked to needs to understand. Sometimes they get confusing. The duty of an insurance company is twofold. They have 2 duties. One is what they call the duty to defend. That is to put their lawyers on the front lines fighting for you tooth and nail. That duty to defend is expansive. It's big. And there's the duty to indemnify, the duty to step in and make the payment for the liability. When a policy is exhausted and you've gone past what the duty to indemnify is, they take that money and they tender the policy. They give the policy to the plaintiff. And then you, the broker, or you, the motor carrier, says, okay, well, there's still some liability left. What happens? Like, do we just wipe it away? The answer is no. Let me tell you what I do when you have exhausted the insurance policy. I lien your trucks. I lien your business. I lien your house. I'll sell your office furniture. I'll get the money. If there's assets to be taken, I will take them away. Now, most motor carriers cannot protect themselves from $100 million verdict. There's a handful of companies on this planet that could handle that type of liability in a regular cadence. But if you see that $5 million case and your insurance is $2 million, Where does that $3 million come? It comes from your assets that I am taking from you. So this is the conversation a broker and a motor carrier needs to have with folks like Graham to say, hey, this is what I have. Is it good? Is this best in class? Am I following the right processes? Because if you don't, I'm going to destroy you. I'll take everything that you have and you can't stop me. So this is one of those interesting things.
I've heard it said before, someone kind of joked about it and they were like, you get in a lawsuit as a carrier, you lose everything. You might never recover. You get in a lawsuit as a broker, you shut down and open under a slightly different name the next week in a different office building because you don't have anything to liquidate. Like they have nothing to come for. And depending on how the corporation was actually formed, right? You might have some protections from like even your personal, like your home and things like that as the owner being something that's come for. But I would imagine it's probably not that cut and dry, but the fact will always remain that carriers have more skin in the game for what they have to lose just because of the actual physical assets that are sitting there on the road too. And if
it happens to
all your assets
Samantha.
taken, it's almost impossible.
They go bankrupt and they buy a new truck and they go out there and run again. Like it's the barrier to enter this business is so little. To get a CDL in this country, it's as little as 3 weeks, right? So like you can get a CDL pretty easily. It's a very interesting business as it's evolved over the last few decades.
Yeah,
I know the TIA and several other groups are trying to add some organization and help the FMCSA and the government, even in their processes, to get some regulation around who can drive a truck, who can enter the workforce and transportation. I hate to say, it's too easy to get in the door. And we need people to operate these businesses, and it needs to be cost effective for them so they can run those businesses. However, we've just got to have an honest conversation that we're all underinsured when we're driving on the road. These companies don't have margins that support them purchasing additional insurance. Many times these motor carriers don't have the capacity, even brokers sometimes don't have the capacity to purchase some necessary insurance to protect themselves and people out on the road. And we just need to be honest that that's the reality we live in America in 2024.
I love what you said there, Graham, because I think the thing I would harken back to is we are watching motor carriers right now move freight beneath the operating cost of a truck. So like people are actually moving freight at a level where they can't maintain their equipment. That's why it's 21.6%. Now, even in good times, it's still about 21.6%. But there will be a day, I do not think it's that far away, when a clever plaintiff attorney makes the argument against a manufacturer or a shipper and says, look, you go out there and buy transportation. You should know what it costs to do this stuff. You're going out there making a bad bet with a bad broker, and you're going to end up getting tagged for this litigation. It's a matter of time, and it'll happen. And you're going to be like, oh, this is terrible, these blasted lawyers. But to answer Graham's point, the solution is it's going to be more expensive to be an American. It's going to be more expensive to buy your things. And people can't afford to spend more on the things that they have. They can't. So this is a problem that is going to be a flywheel of disaster over time. But I think it gets solved with robots. I hope autonomous trucks, maybe
AI. Graham, can you give me, and I don't know, what you feel comfortable saying here, but could you give me like a real example of like, okay, you're a broker, you're entering the space. Here's the bare minimum insurance you need to operate.
Oh,
and this is like, what would it cost for a year, a premium for a year, versus what would it cost to say meet these new $5 million liabilities? Maybe you even have 250 cargo. Like, what is the actual thousands of dollars difference between those two policies on average?
You bring up a really good point, Samantha, which is that you don't need insurance to operate a freight brokerage in the United States. You need a surety bond, which is a similar product.
I want to get to that too.
Well, if you're in terms of like an insurance package, maybe auto liability, general liability, some form of cargo liability, maybe errors and emissions, which is typically the least expensive line of coverage. You can get this package from certain insurers if you don't want your claims to be paid out for maybe $5,000, maybe $4,000. If you're predicting under $500,000 in revenue, all in gross revenue your first year. Setting up that package, if you have claims or freight stolen, I'm really going to expect you not to get any help from the insurance company because the premium is so low. You're really getting what you pay for. Now, maybe setting up a package with a more reputable insurer that specializes in the 3PL space is a broker, and maybe you want $5 million in auto liability and general liability your first year. I mean, you might pay $30,000 for that. So there's a big gap in what you're
So
willing to pay.
$5,000 versus $30,000 if you were like
It
doing
could be.
kind of high-end policies versus like
Yeah.
I just want something.
It's magnitudes different. I mean, if you're running an operating ratio of like 95%, like, and you're surviving, you're not gonna be able to make those changes as a motor carrier. It's almost impossible.
Mm-hmm.
And
So
to your point about, which is bananas to me, that you don't have to have insurance as a broker, and instead you have to have a surety bond, which last time a surety bond is saying $75,000 of coverage, right? Like of not even coverage, like you basically they're putting $75,000 away for you. And if you go bankrupt or you have a damage or something, someone can file against that bond and draw that out. So basically you're saying I'm insuring myself for $75,000. It used to, and this is just me from experience, I once purchased a surety bond in 2022, the end or beginning of 23. And I think it was like maybe even less than $2,000. But I've heard they're going for like upwards of $5,000-$6,000 these days if you can even get approved for one. There's much more stringent requirements for that. What's happening in the surety bond market right now, and why is it happening?
It's a historic year. I'm putting out an article with a TIA on this because they're a great partner and knowledgeable on surety bonds, and people would be interested to read, I think. But in short, it has gained popularity to file claims against broker bonds for any and everything. Just to slow, it could be late pay from a motor carrier. It could be a
like
cargo
the freight guard of brokerage.
That's exactly what it is. It's tit for tat.
Absolutely. Yeah, that's exactly how I think of it. So surety bonds are such a cheap product. And I don't mean cheap, like cheaply made. I mean cheap. And you can buy them for $2,000. You can buy them for $900. And so the surety markets have just been issuing bonds like crazy. Tons of different companies have entered the space just to write these bonds. No claims. It's just an annual premium you're going to get. It's on autopilot, essentially. Yeah. And so this year, now that it's gained popularity to file claims against broker bonds, what's happening is these bond providers are actually starting to fold. I've counted, I think, 8 or 9 that have completely exited the surety bond space. And so what that means is and some of them, like the second biggest one, has exited. So the other markets that are still existing are picking up the slack, and they're dealing with the claims, and none of them have had the infrastructure, in my opinion, and from what I've observed, to even deal with the claims they've had in their own book. So now that there's consolidation and fewer companies offering the bonds, it's just putting more of these sureties just completely pulling out of the market.
So somehow essentially what was happening for years is these people were like, oh, that's easy money. We're going to get a couple $1,000s a year. Nothing's ever going to happen. Nobody hardly, like, you forget it even exists. You talk to the person who writes your surety bond once a year when they say, hey, this is auto renewing. Make sure your payment's like up to date. And you like re-sign the form. And that's it. And then you forget about it for 12 months and like nobody ever knows it's there. Nobody ever did anything with it. And so everybody was just like, I'll take easy money, easy money, easy money. It's like, we actually this seems like reckless and totally irresponsible that we did this. But now that I guess it's just trendy because people are desperate right now. The markets are not favorable. Carriers aren't getting paid quickly. Like, they're utilizing every resource they have to go try to get their money and recoup their money from these brokers, and they're filing on bonds. And now it's just absolutely like you said, like just collapsing the surety bond providers who thought that was a great idea to get into that space. And I would imagine, like you said, let's say exit, it's an unfavorable environment right now for the ones who are staying. So if they're going to absorb those, what happens? Do they say, like, we're going to charge you 10x what you were paying, or like, how does that work to take on that risk? Are they trying to price in risk now? And also, I saw one person, this was a little bit of a different situation, because I know that you could actually get a surety bond too before you have U.S. citizenship. And a lot of motor carriers are immigrants who are still working through citizenship processes. And they wanted, I think, up to $50,000 down or $25,000 or something for the deposit of the surety bond. Like, you're paying into your own surety bond to get the bond.
Yeah, we're seeing it a lot more common now for a new company or someone who doesn't have great personal credit. Surety bonds previously were rated, the premium amount was rated on basically the personal credit of the owner. They do a soft credit check and say, this guy's solid, and your price is $938. Or this one, his credit's on the lower side, we're going to charge him and his company $2,000, $4,000. But now, yes, I believe the price of surety bonds in general is going to have to correct. It's going to have to go up across the industry, or else we're going to have even more consolidation with these markets, which is not going to be good for anyone. We need more competition. But the other thing that's happening, Samantha, exactly what you said, it's becoming a lot more common to look at a $10,000, a $25,000, sometimes even a $50,000 or the full $75,000 collateral. And again, this is the only barrier to entry from a insurance as it's deemed by the government, even though it's not really an insurance product. This is the only barrier to entry in terms of getting your brokerage up and running. So it's absolutely mandatory, else you're operating illegally. You put down a $25,000 collateral plus the actual surety payment, or else you got to pause your business or not even get it off the ground. So this is a major consideration. And of course, it's happening in the same year as the most historic theft any of us have ever seen. So it is quite a historic year. We're in tough times right now. From a rate perspective, we're in tough times. From a risk perspective, I wish I had a fantastic message of hope to give here, but I think Matt would be aligned with me in being a realist, and that good times will be coming. But right now, there's some stuff we all need to work through, and it's going to be a bit uncomfortable, and it's going to cost some money, but we're going to get through it.
Yeah. There was a little bit of a glitch there, and I think that was actually probably me, because I have a Wi-Fi extension plugin in the other side of my house, and I just realized my laptop is still streaming from the other side of the house instead of the Wi-Fi.
Modern technologies, they're phenomenal.
I switched it over while you were glitching. I think we're going to be a little bit better now. So I think like surety bonds in the grand scheme of things, to me, like they're not overly important. I just like to talk about that because I like to bring up the fact that like there have been a lot of little overlooked pieces of the puzzle in like specifically the brokerage space, I think, that are to me kind of like these warning signs of something just a little bit more pressing. And I think I would say that to me, the greater topic that those play into is the barrier to entry for brokerage. And I think that it is still incredibly easy when we really think about what goes into it, but it is getting more difficult. It is becoming more difficult to get into brokerage and to maintain a brokerage than it was 5-10 years ago, I think.
To build off what Graham said earlier, there's no requirement to have liability insurance as a broker. And that means that, to your point earlier, the barrier to enter is super easy to become either a motor carrier or a broker. And I want to use the cases we talked just a little bit about before, because this is something that Graham and I talk about all the time. The Miller v. C.H. Robinson case in California and the Global Trans versus Yee case in Illinois. And they're the same case. The same case is a motor carrier does something dangerous and kills somebody and they get sued. They have almost no insurance. And then the plaintiff spins around and sues the broker. And they say, broker, you're responsible for this. You were negligent in selecting the motor carrier. And the freight broker says, well, actually, we're just price, route, and service. We don't do anything with safety. We're not in that space. That argument was advanced in California, and at the Ninth Circuit Court of Appeals, which is the appellate court, it sits over that area. They said the broker can in fact be held liable for the negligence of a motor carrier. Same exact set of facts in Illinois, Global Trans versus Yee. Motor carrier does something terrible. They sue the broker, Global Trans, and Global Trans says, I'm not responsible. I didn't do anything. I'm preempted by F4A. And the Seventh Circuit Court of Appeals said, you're right. You don't get sued. You can't be held liable. These are different outcomes with the same exact laws. Both of these cases were appealed to the Supreme Court of the United States, SCOTUS, and SCOTUS punted on both of them. They don't think it's a big problem. So if you're a broker and someone says, hey, I just had this catastrophic accident, am I liable? The answer is only it depends. It depends on where you are. And if you don't have insurance, guess what, buddy? You're done. You're toast. Because as Brandon Weissman said in the comments here about the duty to defend, that duty to defend is triggered by you having paid for insurance. If you have a policy that your limit is $100,000, your insurer is paying for the lawyer that entire litigation. That duty to defend will easily be higher than the overall liability you face, but they are there fighting for you. So if you're a broker and you're like, I don't need to have this liability, the government doesn't tell me to. Let me tell you, you should have that insurance, because if you don't, we will destroy you. It's terrifying, but people need to understand that these things are real. And if you don't follow them or understand them, your ignorance of the law is not a defense. We will break you.
And don't ever say like, this isn't going to happen to me. Because if you
absolutely.
talk
Oh,
to
yeah.
any broker who's been in the space for a while, they might have gotten lucky and avoided like fatality incidents. But so like something that I found kind of horrifying and at the same time mind-boggling to me was like with Highway or any other carrier vetting platforms, I'm sure you can look at like the fleet's unsafe driving scores, and it will show you like every time there was an incident and if it was a tow away, a fatality involved or not. And some of these carriers who are like a decent enough fleet size, that their overall like metrics are still like, oh, under average, but then you look and it's like fatality, tow away. And I'm like, oh my gosh. Because
even if you're not liable, Samantha, even if you're not liable for the ultimate problem, to defend a lawsuit without insurance, like you're spending probably $20,000 to $50,000 a month. Like no broker worth their salt
off
can
of your
actually
10 to 15% broker margins for that.
100%. Like there is no margin in this game for doing it the wrong way.
There's not.
And so
That's not.
the FMCSA is not going to come in and mandate liability insurance for brokers. They're not probably going to do that. They're still kind of even skeptical about double brokering and freight fraud. Like they're going to make some new login credentials. It'll make it more difficult to steal someone's MC, but that's not their core business. They are safety. That is not about like fraud and all this. So we have to, as an industry, kind of understand underinsured motor carriers, poorly maintained equipment, and brokers who are the intermediary who may or may not be held responsible for the negligence of their providers. It's interesting.
It's quite an equation.
One last question I want to ask because we're getting long on time here, but because I love brokers. I was a broker. I love the space. I fully believe brokers have a purpose and a role that is never going away in our industry. And I think they just need to do it the right way to complete their role the correct way, because there is a correct way. But as a broker, I worked with a lot of enterprise size companies, which I would kind of just loosely say $1 billion plus. And typically most of those companies that size have a legal contract that you sign into when you go to do partnership. I actually worked with Graham at Reliance Partners as my insurance provider at the time. So every time I would flip over a contract to Graham and we would talk through it, and we would talk through like the cost to serve basically. Like, cause I cut through the course of 2023, 22 and 23, like we saw like terms were they were asking more from an insurance standpoint, like things were changing. And I'm sitting here evaluating the financial implications of going from a $2 million to a $3 million liability, or adding more excess, or even sometimes like workers' comp from like $500,000 to $1 million and things like, and I'm like, why do you care? Like, why do you, Mr. So-and-so 500, Fortune 500, care about like if my workers' comp policy is $500,000 or $1 million? And like, do you want like what? Then again, why do they not care what that does to our operational cost to serve them? And I think that the answer is partly like what you mentioned earlier, Matt, and that in a low market, who cares? Because like they're not going to get pushbacks on legal contracts. And there was a clear, if you redline this, you are not even going to be considered for onboarding.
Yeah.
You are not worth our legal resources right now.
Yeah.
So my question is this. To shippers listening, it's scary. It's scary when we talk about, like you already brought up, manufacturers could eventually be like pulled into some of these things. It's not a far stretch. Like once we figure out how to make sure we're really pinning down the motor carriers and the brokers, why not go for the manufacturers next? But I think that they're putting these terms out there to protect themselves and just like say, I'm scared, so let's do this just to be safe. But is this sustainable? And is that an approach that is considering a true partnership for motor carriers or for brokers? And I don't want to alienate anyone or point fingers. I just want to have a quick, honest discussion about this.
Well, there's 2 points I'd like to make on that. First is what happened with IKEA. So IKEA was doing business with Convoy, and Convoy wound down, and IKEA owed motor carriers and Convoy $500,000. And they said, we have no idea who to pay. We're not going to pay Convoy. We'll take this money, we'll put it into a federal court in Illinois, and those motor carriers will make claims against the $500,000. Brokers made a bad name for themselves because these big enterprise shippers were like, I don't know if I can trust you. We're going to have to ratchet up our control and make sure you're financially stable. Now, the other piece I think is probably more nuanced, and I hear my kids screaming in the background, so hopefully that's not interrupting anything.
Not coming through.
But the thing the other piece of this is, how does a lawyer pierce the corporate veil? So if you are a broker, you made a company, an LLC, a sub S corp, whatever it is, and if I want to get your personal assets, I have to pierce the veil. One of the ways I can pierce the veil is you underinsure your company. Now, if I am a shipper, manufacturer, and I have these ideas of, I think you should have this amount of insurance, I think it's a reasonable jump from their internal counsel or the outside counsel that they work with, saying, hey, if we are requiring only this, and we know that only this is probably not enough to handle a big issue, maybe we should be more proactive in making sure our policies reflect the risk that our brokers and our motor carrier partners are doing. So I think for them, it's a bit of proactive pathway, saying, let's reduce the capacity we can bring on, and let's make sure that we are adequately insuring through our contracts who we're going to work with. And I think that's a reasonable path to try to avoid liability ultimately for the acts and omissions that a motor carrier or a broker may do.
Mm-hmm. Yeah, that's pretty good, Matt. It's going to just be an honest conversation, and there's not going to be a solution, because once a shipper has decided that the limit they want to see of all of their broker partners is 5 million, let's say, or even 7 million, let's pick a more nuanced number that we don't see a lot, but we do see. Once they decide that, they're not going to lessen that. No. Once they've gone through the paying their legal team to establish that clause in their in the section that stipulates what insurance they need brokers and carriers to have, they're not going to back down from that. So it's the new benchmark. And what that means is there's going to be fewer and fewer brokers who are going to be able to partner with that shipper unless they walk it back. So some shippers will accept red lines, and there's things that should be taken into consideration. Not every broker or their certificate of insurance is created equally, of course. And so there's going to be some that have other selling points that should be taken into consideration and might be able to redline that same contract. However, once we see these limits elevated, it's going to be exclusionary to many of the brokers out there who are trying to get in with that shipper. And we all know this. We've seen the contracts. They get brought to me. I don't know how many shipper contracts at this point. And so it's just going to be a consideration of, and here's a real example, a broker client comes to me, we evaluate, we have 3 million in auto liability, and this is a larger broker, and we need to get up to 5 million for this particular contract. What does it cost? So we run an analysis, we run a quoting process. It's going to be $30,000 essentially. So this is a real business consideration. The broker can pay it. It's, I think the premium is equivalent with the risk for a broker this size, but $30,000. What if they get in with that shipper, they purchase the insurance, that shipper tenders them no freight whatsoever? They actually shut down.
Graham, sometimes it's not even, I have to say this, sometimes you can't even see the RFP until you say and prove you have the insurance. You can't even get on the spot board until you prove I have the insurance. And so we're literally talking about $30,000 to have a chance at maybe some money, maybe some negative margins on your business. I don't know what I'm getting into. No award in hand. Oftentimes, no even like strong intent to do business with you from that side, because we already have a couple brokers who are already doing it. So it is crazy, but it is also, just like you said, the reason I say it's not going back is because the brokers who were able to afford that and adopted that, it's now their competitive advantage. And they're now walking into saying, I have $5 million liability. Like we take these things very seriously. We have all these resources. Like this is the other Fortune 500 names I'm dropping on you that I'm serving. And there is going to become an increased cost to serve, but also with that, an increased barrier to entry within certain niche markets and business partnerships within the space for brokers and carriers.
Yeah. And there will always be a market for shippers who don't require crazy insurance or any insurance of their broker partners. I've met several companies and I've called on them to see if they want to buy some insurance perhaps. And they say, insurance, why? I don't need insurance, not required. Yeah. And so I've yet to be successful in the education process around that of talking to a broker who hasn't run, maybe they've been around for 30 years, have never purchased insurance for their brokerage. I'm not going to win the battle of education there, most likely, in saying, well, it's a competitive advantage for you. Also, it helps protect your business is really the main point. But from a sales perspective, big brokers are going to purchase big insurance packages because it's going to allow them to have such an easy process of business getting in with the enterprise shippers that they want to partner with. So it is a competitive advantage, and can be a great protection as well. But really, it's always going to be at a cost, and we're going to see that cost rising, unfortunately.
as a sales consultant, something I say pretty often is an educated customer is my best customer and an ignorant customer is my worst customer if they become a customer. And kind of along that lines, like if anybody was listening today, I had a couple takeaways. Number one, if you're a carrier, consider what the difference between $750,000 and $1 million liability is doing for you as far as the proverbial rooms you're even putting yourself in, right? Like, are you even getting yourself seen, or are you an automatic filter out of the options when someone's reaching out to a carrier to talk about a 12-month contract rate opportunity running above spot rates? Are you even in that discussion internally within a brokerage? I've had so many carriers be like, I've never had a broker reach out and offer me contract lane opportunities. I'm like, well, what's your insurance? Because you might be getting filtered out, because almost every major broker now has a dedicated like strategic capacity sourcing team that is every day dialing to find strategic carrier partnership fits for dedicated lane matches. Or they should, in my opinion. And then on the brokerage side, like, again, are you excluding yourself from potential books of business that are an actual fit for your operational model and your niche markets because you haven't considered what a different insurance policy would do for you? Just get a quote. That's what I would say. Get a quote. Like Graham and his team, they'll give you a quote, and you don't have to pay like to get the quote process to see like, well, I was told no on this RFI or on this RFP because I didn't meet these qualifications. What does it cost me to meet those qualifications? Go find out and see if that makes sense for you to evaluate that from a sales standpoint and potential revenue standpoint. If you can get yourself in front of more people and in more positions to start growing your business just because you change your insurance from $1 million to $2 million, or have an excess added on, or cargo coverage from this to this. So evaluate those things. Also, get a good lawyer if you know.
Oh yeah.
My advice to everybody is this is an industry about preventative maintenance. You maintain your truck, you maintain your trailer, but you have to maintain your relationships with your critical service providers, your insurer, your attorneys, and you have to have these things evaluated and looked at. The state of the art changes rapidly. It changes rapidly. Using someone like Graham or the team at Reliance Partners to look at your contract language, look at your policies and say, am I doing things right? Because the reality is the worst case scenario is not a question of if, it's a question of when. You will have a day when something gets stolen or some catastrophic accident happens, and it is making sure that you're ready for those things. Do not defer maintenance on your truck. Don't defer maintenance on your contract. Don't defer maintenance on yourself. Get out and vote, people. It's time to do it.
Go walk there. Yeah, get your steps into self-maintenance. Okay, well, awesome. We had lots of great comments today too, and thanks for being here, guys, and for listening in. If anyone listens back to this, we stream this on I actually just thought it was Spotify and Apple, and my producer said there's like 18 platforms out there somewhere that this goes to in the
fantastic
universe. So if you guys are listening and you have questions, you can always come back to LinkedIn and find this episode on LinkedIn and leave a comment. And I moderate those. If you think it's a good one for Matt or Graham, I'll tag them back in too to make sure we get answers, even post live show here. So thank you to everyone who listened in today. Graham, thank you. Matthew, thank you. They're like tagged in the comments already, I believe, on the post, and they're listed as speakers. So you can find their LinkedIn's. Both of them would love for you to message them if you have questions or you want to talk more about what they do or the services that they offer. So yeah, thank you guys for being here today.
Thank you, Samantha. Thank you, Matt.
All right, guys, I have to end my own podcast now because I don't have a producer. So here we go. I'm signing off.
We did it.